What's driving insurance companies' increased allocation to private credit? Between 2019 and 2022, insurers increased their investments to private credit by 35%. Private credit has historically provided enhanced returns in exchange for limited liquidity. However, managing these securities may create liquidity challenges that can be difficult for insurers. Hi, I'm Lynn Bachstetter, Head of Cross-Product Market Development at S&P Global Market Intelligence. And joining me to discuss how indices are helping insurers navigate the liquidity challenges of investing in private credit are Bill Ahmuty, Head of Spider Fixed Income at State Street Global Advisors, and Frans, Head of Fixed Income, Commodities, and Currency for S&P Dow Jones Indices. Welcome.
Lynn, thanks for having us.
Thanks.
Great to be here. Thank you, Lynn.
Great. So, Bill, I'm going to start with you first. Historically, what have been some of the challenges of private credit investors in managing liquidity?
Sure. Well, thanks, Lynn. If we think about private credit, it's certainly stolen the headlines in 2023. And in thinking about the liquidity aspect of it, I like to think of it in both the initial investment side as well as the exit strategy as well. So if you're an insurance company asset owner and you're thinking about investing, you spend time with your due diligence about how to get into a private credit investment, many of these funds are drawdown funds, and so your allocation may take time. So that inability to invest all at once could certainly provide some cash drag on your portfolio and hamper your ability to really maintain the asset allocation that you're looking for, and ultimately could hurt your performance relative to a benchmark in the long run. On the exit strategy, certainly most or every investor should be aware of some of the lockup periods. But if you do need liquidity, it's going to come at a cost to investors, right? So I think that's where folks do get a little bit concerned when it comes to liquidity, that they may have to wait to get their money out. And that's why when we talk about different opportunities to pair other instruments with that, which we'll get to in a bit, I think it can certainly be helpful using both public and private markets together. And so, to the extent that folks have the ability to really suggest to their manager or ask for in their IMA to be able to use, say, an ETF, I think is also very helpful.
Thanks. You mentioned different instruments. So can you talk a little bit how market participants have used index-based strategies to navigate some of those challenges that you just mentioned?
Great. Well, thanks, Lynn. And again, I think when we talk about some of these products, it could be index-based or even actively based strategies. But an ETF, for example, that really helps provide a lot of liquidity because it does trade on a daily basis. It also has a few other benefits, not just the trading of daily liquidity, but also some diversification benefits, such as, if you think about an ETF, it's one instrument, but it may have 200, 300, 400 different loans within that. So you're going to have broader sector exposures, more diversification in terms of your rating, and even size of the loan. So using an ETF or an index-based strategy can certainly add to the overall diversification of that portfolio and of the strategy.
Well, that's a great segue to you, Frans. So your team owns and manages the iBoxx Liquid Leveraged Loan Index. Can you talk a little bit about its use and how it's constructed?
Yes, of course. Thank you, Lynn. The iBoxx Liquid Leveraged Loan Index is a 100 loan subset of our broad market loan index, which represents all the areas of the main USD leveraged loan market. The index prioritizes liquidity, and therefore it creates an index which is replicable and great for underlying to ETFs and other derivatives and tradable products. We do that by referencing our market intelligence, loan pricing, liquidity scores, which is a metric which takes into account many various factors, including the amounts of dealers quoting, number of quotes, but importantly also the bid-ask spreads. The index also has a governance framework with a committee, which allows us to consult and update the methodology as the market evolves. We've done this multiple times in the last few years in order to facilitate monthly or intra-month cash reinvestment, but also the replacement of loans when there are refinances or other activities. The index is also highly correlated to the broad index. That means that it's higher than 96%, and you get the same daily return exposure, but also it has a greater than 8% coupon, which is in line with the broad index, and allows you to get that exposure, but at the same time still have a liquid index. And one item to add is that the methodology and the documentation for our liquid leveraged loan index is all transparent and publicly available. And we leverage the comprehensive loan data sets we have internally at S&P Global to create these indices. That is our loan pricing service, and pricing data, which is market leading, but also the data from our WSO data, which is the most recent issuer and transaction data in the market.
Thank you. I know you spoke a little bit about the index specifically, but there has been an ecosystem that has been developed around this index. So can you talk about the liquidity that comes with this ecosystem around iBoxx?
Yes, definitely. And at S&P Dow Jones Indices, we always prioritize supporting our clients and our partners, creating liquid ecosystems across our indices and our flagship indices. For example, with the iBoxx Leveraged Loan Index, and it's no different, especially for the liquid index, where we have partnered with the sell side to create standardized return swaps with more than 6 dealers now quoting and these contracts being liquid. Now, how that works is we have, or S&P Dow Jones Indices publish trading documentation and conventions, which allows all firms and market participants to trade the exact same contract in a fungible way so they can get the same exposure. That allows multiple use cases. It allows firms to go long, go short, but also utilize these contracts to manage their liquidity sleeve. These contracts trade more than 20 billion in USD gross notional annually now, and they often used in tandem with the ETFs. So that allows firms to manage their exposure and their risk alongside the ETF, but importantly also for relative value trading.
Great, thank you. And Bill, turning it back to you, can you talk more about how market participants have used senior loan ETFs and obviously in these volatile markets?
Right. Well, you talk about volatility, and if we look back at the markets over the last roughly 2 years, the volatility has really been driven by interest rates. And starting about Q1 of 2022, as the Fed started increasing rates for the first time, you saw the MOVE index, which is a measure of interest rate volatility, really spike a bit higher, and that's remained at an elevated level for some time now. And the use of loans and loan ETFs is helpful because loans are floating rate by nature, so they don't really have that duration. They don't have that price impact that's caused by a rate movement, whether it's daily, weekly, et cetera. So using a loan ETF in that fixed income portfolio really helps to decrease and hamper some of the overall volatility in the market in your portfolio. And if we think about another aspect of loan ETFs, typically having a higher coupon and distributing income perhaps maybe monthly or quarterly, that income into a fund is also beneficial for investors to take income in and help buffer some of the volatility and price movements of the broader market.
Great. Well, I want to thank you, Frans and Bill, for joining us today.
Thank you very much.
Thanks a lot, Lynn. Thank you.
For more information on the iBoxx Liquid Leveraged Loan Index and S&P Dow Jones Indices range of fixed income benchmarks, please visit us at the link below.